Greetings from your investment advisor, Scott Campbell, with my market review for the second quarter ending June 30th, 2026. By the way, all the opinions expressed here are mine, not your employer's or your former employer's, just those of a fiscally conservative libertarian. By the way, the purpose of my little message here is just to give you a recap of what's gone on in the economy and in the stock market in the United States over the last quarter. Simply put, the stock market is driven by corporate profits, otherwise known as earnings. I know if you watch the internet or watch cable news, you'll hear a million things that apparently affect the stock market. And there are a lot of tiny things that have a tiny effect on the stock market day to day. Earnings are what drives the market, profits. And companies make more money, more earnings, more profits when the economy's doing better. So I like to just give you an overall review of what's gone on the past quarter so you can get a good idea of what's going on with your investment accounts and not have to listen to the news every day because it's tedious. I love the US stock market. Nothing grows money more consistently. And I have a fantastic relationship with the stock market because even when it disappoints, and it rarely does, when it does, it's for a very short period of time. And the market always, and I mean always, makes up for the disappointment with tremendous returns. Wouldn't it be great if family and friends paid you a dividend if they ever disappointed? Well, at least we can hope and dream. You'll recall in the first quarter, the market dropped due to the conflict in Iran. By the way, it's a good time to point out that that drop in the first quarter in stocks, well, that's the price investors pay to invest in the stock market. The stock market can produce amazing returns, but they're not free. What comes with amazing returns are ups and downs. You got to be able to handle the downs in order to get the ups. It's just the way the market works. And speaking of great market performance, last quarter, this past quarter that just ended, the market was on fire. Market for the quarter was up over 15%, bringing the year-to-date performance of the market up over 11%. Absolutely phenomenal. The tech-laden NASDAQ had the best quarter since 2020 last quarter. Okay, I have from my email the matrix that shows the performance for major market indices. The first three Bloomberg indices measure bond performance. The first measures short-term bonds like high-yield savings accounts and CDs. Performance of short-term bonds has started to moderate a bit. When bonds started making their fabulous comeback over a year ago, short-term bonds led the way with tremendous performance, almost 5% annually at one point. That's incredible performance considering short-term bonds are almost risk-free, meaning very few drops in value, if any. The next Bloomberg index measures all bonds, which have been doing okay, not great, but investors invest in bonds primarily to reduce the risk or the drops in their portfolio and for income. The third Bloomberg index measures long-term bonds, the most volatile of all bonds, and they are at least outperforming all bonds as of 1 year for the first time in a very long time. The extra risk associated with long-term bonds has just recently started paying off. The next indices all measure stocks. The DJ Total Market measures the entire US stock market. Again, up over 15% for the quarter and now up over 11% year to date. Not bad considering the first quarter was down. And anytime your annualized performance exceeds 8%, you're in the gravy, baby. The next index is the S&P 500. This index holds 500 of the largest companies here in the US. All of the companies we know, love, and can't live without. Up over 15% for the second quarter and up over 10% year to date. The S&P 400 mid cap measures medium-sized companies like Marriott, Palantir, FedEx, and Shopify, which, like the first quarter, for the second quarter and now up over 17% year to date. The Russell 2000 measures small companies and was up over 21% for the quarter and over 22% year to date. Unbelievable, phenomenal. Small cap stocks resurgence started about a year ago. Up until that point in time, small caps did not perform up to expectations. Large cap stocks, the S&P 500, were the stocks that drove market performance over the last few years. The last index, the MSCI EAFE, measures foreign stocks. It had a good quarter, up over 10% and up over 9% year to date, which is good, but not the performance foreign stocks produced last year. Okay, I want to review the economy, and I've got my cheat sheet here with me. So, the first broad measure of the economy is referred to as GDP, the gross domestic product, and that measures all economic growth in the United States. Currently, it's estimated at around 2.2 to 2.5% annualized. The forecast for full year growth is between 2.4 and 2.8%, which is up from last year. Long-term normal is between 2 and 3%, 2.5% being a good gauge. So GDP growth is reflecting moderate expansion in the U.S. economy. The next broad measure is consumer spending. Very important because 70% of the U.S. economy is driven by consumer spending. Consumer spending in the second quarter was up, rebounding from the first quarter, and is now at a modest growth pace. Business investment was solid in the second quarter. Businesses are spending on AI and tech upgrades. Labor. So the unemployment rate averaged at 4.3% in the second quarter, which is historically low, but it is showing signs of some softening. Job gains were modest in the second quarter, private sector and healthcare leading the way. There was weakness in retail and leisure. Wage growth was steady, but not accelerating sharply, which would be a sign and a problem of inflation. Inflation itself, the CPI, which is the Consumer Price Index, is approximately 4.2%. There is some pressure from higher energy costs lingering from the war in Iran, but forecasts are for those higher energy costs to ease as we go into the latter part of 2026. All in all, the economy is performing well, even in the light of a war. The outlook for the rest of 2026 is an improving picture across all data points. Please keep in mind the U.S. economy normally slows in the summer. And if we do have a normal seasonal slowing this summer, the media is going to jump on it and call it an indicator of bad things to come. The market's also doing very well. It's on fire, actually. The outlook for the rest of the year is very positive. But again, if we have a summer slowing in the economy, that is going to impact earnings in corporations. So we could see a little softening in the stock market. And again, the media, if that happens, is going to jump on it and call it the beginning of the end. So, as I warn you and tell you all the time, don't listen to the media. If you have any questions, concerns, issues, reach out. Give me a call, send me a text, email. Let's talk. I can walk you through any of your concerns. Lastly, please click subscribe below and you'll be updated to all my new videos and podcasts. And on that, I have developed a new podcast dealing with financial wellness. My podcast is called Cash Talk with Scott. So if you click subscribe below, you'll be alerted when I post a new podcast. And you can cruise my YouTube channel, see what I've got, see if there's anything of interest. And you're always free and welcome to get a hold of me for more information, for more help. Thanks, and I hope to chat with you soon.